Hi, and welcome to another edition of Weekly Market Report by tradersclub.co.uk. This report is covering week beginning 6th of January 2013. As per usual, let's start our analysis by looking at the disclaimer. Anything that we discuss here is available in a public domain and therefore it should not be considered to be advice for your trading or investment. We are simply sharing the information for the benefit of the club members. I would like to start this report as per normal by talking about S&P 500 in a daily time frame. We had quite a bit of a pullback prior to a resolution of the fiscal cliff, and subsequently last 3 or 4 trading days produced this quite a significant rally, and we're currently retesting this rising resistance trend line. Prevailing sentiment is quite bullish. However, we did come up quite high in a very short period of time. So this rally does look a little bit extended. The obvious resistance on the upside, it's clearly located here, these 3 previous highs. So 1464, which was the previous peak, we closed daily above that, followed by 1470, which is the peak here, and then 1474. Only the daily close above this rising resistance line would potentially indicate a further upside to come, potentially targeting 1499. Alternatively, if we see a pullback, it would probably be healthy, and I think we can see it clearly in a shorter term time frame. This is an hourly chart, intraday, assuming that these indicators are telling us this is overextended a bit. This is actually a rising wedge formation as well. And if we potentially see some pullback, support on intraday time frame could be found here at 1459, which is a 20 period moving average on hourly time frame, and then subsequently on any of these fib retracement levels from 1398 low to the current high. So 1440, 1432 would be quite healthy and acceptable, followed by 1424, which is very close to 200 period moving average on hourly time frame as well. That would give enough time to stochastics and MACD and RSI to go back into neutral, and then push higher again. So it would be quite healthy if that happens. Alternatively, as I said, if we see a daily close above this level and a nice candle formation above that level, it could still be bullish and we could see more upside to come. Volatility index dropped lower quite significantly. All of this rallying and actually trading, price action was trading above upper Bollinger Band, breaking out above this falling trend line which was formed, was basically during the time when S&P was pulling back and selling off, and loads of uncertainty with fiscal cliff negotiations and so on. As soon as S&P started rallying, we saw the huge massive pullback, and VIX is currently retesting quite a significant lows. So levels here are 1330, 1350. These levels must hold, otherwise we'll see a further drop, which would mean that S&P is rallying. Alternatively, if we see a little bit of a pullback in S&P, this could very easily base here, consolidate, and then spike higher. So the levels that I would be watching here would be around 15 level, followed by 1695, followed by 1750, all 51, all kind of fairly logical levels. Copper daily time frame, it's still showing this protracted consolidation, trading range, creation of this really long-term triangle formation. There is another triangle inside as well, which was kind of broken. But current price action is indicating that copper is pulling a bit. So if I see a daily close above this resistance level, especially 375 level is the one that I'm watching, then we can very quickly target 383, possibly 395, 96, even 4 very, very quickly. And in that case, it would mean that stock markets and in particular S&P is rallying as well. Alternatively, if we see a bit of a pullback, logical support would be based here around 365, 357, and then 352 levels as well. So there is another trend line kind of going out this way as well. So these are the levels that I'm watching in copper. Gold price, obviously we had quite a lot of fun with that. Gold was falling initially together with dollar while S&P was rallying. So we had a kind of bounce back, which is all healthy. This channeling trading range resembles a bull flag in a really longer term time frame. And I actually quite like this basing here, because the same number of points, if we assume that this is A and this is B, this is C retracement, the same number of points from here to here would be fairly similar from here to here as well. Although gold was selling off as soon as the FOMC minutes were published and indications were made that Federal Reserve might stop with QE3 sometime this year, that caused dollar to rally, and then obviously euro and gold and everything else sold off. A strange thing was that oil did not sell off as well. But loads of buyers came back around these levels, 1630. They were fairly inviting levels, and the Friday candle created, although this is a bearish candle, it created a hammer-like candle. I would like to see a green head or green body. That would be more significant, but I'm actually quite happy with this as well. This could potentially be a double bottom, but I would like to see another green candle here. I would definitely be looking out for a breakout above this level. 1720 and a daily close around this level would be quite a significant for me. Currently, resistances on the upside are clearly located around 1684, 1680, 1695, 17. So any of these levels can be a resistance on the upside, but this falling trend line is quite a significant resistance. Alternatively, if we see further price softening, then I would be definitely keeping an eye on this 1636 level followed by 1630. I would be very unhappy to see gold dropping below this level as well. Currently, stochastics, MACD and RSI are fairly neutral, which means that either move can happen, but I'm sitting on a bullish side with this trade. WTIC or NYMEX oil reacted quite positively to everything that was happening during December, fiscal cliff negotiations, and definitely FOMC meeting minutes, and then non-farm payroll as well. So it looks like that price is actually breaking out above this channeling trading range, and the significant development is that the current price action is sitting above 200 period moving average. Worrying bit for me, or a red flag, is that stochastics is currently in overbought and curling up, which potentially could call for a pullback, and there's this huge overhead resistance in the shape of this falling trend line ahead as well. So support on the downside for me would be here around 90, followed by 89, 03 and 87. Alternatively, if the price spikes higher. Yet again, we are looking at 93.66, 94 level, followed by 95. So the daily close above these levels would be very bullish, but a pullback would be healthy as well. And the last chart is the chart of dollar index. Dollar index was fairly bearish up until recently, and as soon as we had the FOMC meeting minutes published an indication that QE3 might stop, we had this huge rally in dollar index, which is index that tracks movement of dollar against the basket of 5 major currencies, and we are back around this 80 level, or psychological 80 level. The worrying bit is that the current price action spiked higher, trying to retest 200-day moving average, and it failed, creating this inverse hammer on a daily time frame. So we have a falling resistance trend line, we have upper Bollinger Band, and we have 200-period moving average there as well. It's quite possible that dollar index price could pull back. In that case, support that I'm looking for would be based around 80.20 level, which is 50-period moving average, followed by 79.83, and then 79.57, 79 levels. So these are the levels that I would be watching. Alternatively, if we spike higher, then we would definitely need to close above 80.66, followed by 80.82 in order to target 81.46, 81.50 level. So it would be healthy to see a pullback anyway before we move higher if the Fed decides to stop with QE3 as well. Hopefully you enjoyed this short report, and I look forward to seeing you on any of our Traders Club live sessions. So stay in touch and stay safe. Thanks. Bye.